Shall we pray? Heavenly Father, we thank you so much for such an opportunity to learn together as one people. We pray that as we are about to learn, you grant us the spirit of wisdom and understanding, the retentive memory, so that day we can reproduce and pass our wisdom. In Jesus' name, I will pray. Thank you. Amen. So let me open the questions. Go to. All right, so please, I see the questions. I think we solved up to we solved question 8, right? Then we solved question 9. Is that so? Hello? Am I correct? Then we did. We solved question 9.
Yes, sir.
Then we solved Johanny. Do you remember? I remember a
Yes,
gentleman
sir.
read and then I said it's a Cambodian voice. So I think we ended up question 10. Is that not it? Yeah. And I went through
Yes, sir. We
Units
ended up
Limited.
question 10.
We didn't come to question 11. Okay. So let's continue from question 11. Question 11. Okay. So from question 11, I'll skip question 12 and 13. That one I have to treat a chapter before we solve. I will save 12 and 13, then we come and solve question 14, 15, um, 16. I think we solved. Yeah, we solved. So we'll look at them. We'll put some of them and solve. 18 will solve. So let's see. Let's go and quickly look at that. So let's see question 11. So I'm going to insert question 11 on your screen. Is it readable? Is it okay by you? Is it readable?
Yes, sir.
I'll expand it again. So that's better. All right. Now let's read the question. So now a melodious voice can read for us. Okay. If there's no sweet melody, let me read with my Cambodian voice.
No, Joe.
Eunice, Eunice prepares financial statement to September 30th. A minute. To September 30th each year. During the year ended 30th September 2016, Eunice entered into the following transaction. So the year end is what? 30th September, which means that the year start from where? The 2016 year start from where? 1st October 2015. Do you agree with me?
Yes, sir.
Okay. On 1st October 2015, which is the beginning of the year, Eunice purchased an equity investment in entity Y for 12 million. For to a minute. Can somebody read for us what's on the background? A minute. I'm just sending some links to some people. Okay, so on 1st October 2015, Eunice purchased an equity investment in entity Y for 12 million. So that is the cost or the face value, right? Unit purchase. So we are talking of in the books of units, you are looking at what? Is there a financial asset or a financial liability? Hello? In the books of units, are you looking at financial asset or financial liability?
Asset.
An asset. Because of the verb purchased. The investment did not give units control or significant influence over entity Y, but the investment is seen as a long-term one. If you buy shares and your intention is to keep it into the long term, the investment decision is a long-term one. Which classification will fit to this? Hello?
Yes, sir.
Once it says, we said that amortized cost is out, right? Right? Unless it is redeemable by cash, then we say that yes, it's a financial asset. So we look at the characteristics. If it meets the contractual cash flow test, the amortized cost will come in. But this is purely an equity instrument, shares that have been acquired. And the purpose is for a lot to hold it into the long term. So which calculation will be suitable? Hello? Please, the last time I remember I explained this. If they say that the entity had bought an shares for short-term purposes, what does it mean?
For trading.
Yes, it is for trading. So once they say that the investment is seen as a long-term one, it means that it is not held for trading. Did you get it?
Yes, sir.
Yes,
Aha.
sir.
So whether it is held for trading or it is not held for trading, once it says, the first classification that comes to mind is financial asset at fair value through what? Profit or loss. But we saw that the previous question that we solved, they said that the entity had a policy of recognizing financial asset at fair value through profit or loss only when it is a requirement. So we said that in that case, it means that the only point we will treat financial asset at fair value through profit or loss is when the other classification cannot be met. Not getting it. In other words, when it is held for trading, that way it makes it compulsory for you to treat it at fair value through profit or loss. This one, the entity doesn't have that policy. So you will tell us that yes, ordinary or primary, it should be treated at fair value through profit or loss. That is the financial asset should be treated at fair value through profit or loss. However, since it is not held for trading, the entity can make an irrevocable election to also treat it at fair value through what? Through
Yeah.
OCI. We learned that once it is not held for trading, it can be under either fair value through P&L or fair value through what? OCI. But for fair value through OCI, you need to invoke the option to designate at fair value through OCI. Did you get it?
Yes, sir.
Okay. On 30th, if there will be a question on financial instrument in March, it will be similar to one of the questions we are going through. And this is the reason why I'm taking the pain to take you through a lot of the questions. At least you should be able to do about 20 questions. And it should be fine. On 30th September 2016, the fair value of units investment in entity Y was estimated to be 30 million. This is the fair value. Explain and show how the transaction should be treated. So you see that the question is centered on the explanation, because for the treatment, you don't have much problem. All right. So you say that this is a financial asset. A financial asset or equity what? Equity investment. You say that since the investment is seen as a long-term one, then it is not held for trading. It is not held for trading. In other words, whenever they tell you that they bought shares and the intention is that they want to hold it in the short term, it means that it is held for trading. Take note of the difference. It's not every day that they will tell you that, oh, it's held for trading. It's not held for trading. This is another way of writing it. Please, you get it? Okay. Okay. Now, it is not held for trading. So the first point is that it's a financial asset because of the verb purchased. The second point is that it is because it is seen as a long-term one, then it is not held for trading. So now you tell us the classification. The shares would normally be classified normally because whether held for sale or not, it is at fair value through P&L. Okay. The shares would normally be classified at fair value through profit or loss. They say that, however, since it is not held for trading, the entity may opt to make an irrevocable election. Please, as I've been writing these things, always, you should be keeping it in your head. So that you use the right terms. I get it. At the beginning, I said that it's a decision. The entity will make a decision that cannot be reversed. But as you move on, you should, the right terms should skip in your head. Instead of saying that the entity should make a decision that cannot be reversed, you say that the entity should make an irrevocable election. Please do get it.
Yes, sir.
The entity may opt, and I want to use the name of the entity, Unis, yes. So Unis Limited. Unis Limited may opt to make an irrevocable election to designate the shares at fair value through other comprehensive income. Other comprehensive. So no examiner will take anything from you. Full mark. So they show you, now that you know that they can treat it as fair value through P&L or fair value through OCI, they show one, you come and show how to be treated and the fair value through P&L and the fair value through OCI. That's all that you are done. So let's see. So you take the I. Financial assets at fair value through P&L. So that one, let's see. We have the initial measurement. The initial measurement, we have only the face value, right? How much was the face value? How much was the face value?
12 million.
12 million. You need to bring it. That's the initial amount to recognize. Then subsequently, we measure it at fair value. So you write subsequent measurements. That is at what? Fair value. So Eunice statement of comprehensive income extract for the year ended 31st what?
30th September.
Okay, 30th September. No be the wedding na kwashe 31st September. Sana why not just on worry. We check na bibi any. Okay, so profit or loss. So we have fair value what? Fair value gain. The balance at the end of the year was 30 million, right? So 30 million minus 12 million. Is that not it? That
Yes,
will give
sir.
us 1 million. Is that not it? Did you get it?
Yes, sir.
In the statement of financial position, we have non-current assets. So you just write investment or equity investment because it says equity investment. The value is what? It's 30 million. So you are done with fair value through P&L. Then you now go and show the extract for fair value through OCI. Financial assets at fair value through OCI. Please, along the line, if you've gone through the question and you have any question, you can ask. Sometimes after when you've gone through that, you can have the question. So you can feel free and ask any question. Oh, in the previous question, there was I'll answer. Don't worry. Just answer. Just ask your question.
Okay, sir. Thank
Okay.
you.
So financial asset at fair value through OCI. So that one, the initial measurement is at what? Face value, 12 million. That's all. So this one would have deducted discount like the fair value through P&L. The difference is that with the fair value through P&L, if there was transaction cost, we would have expensed it. But with fair value through OCI, we would have added any transaction cost. Is that not it?
Yes, sir.
Is that not it? And also the changes in fair value. This one we are going to show it under what? Under OCI. So we say that subsequent measurement at fair value. Subsequent measurement at fair value. I think we've not done much on financial liability, so I think we'll go and pick all the questions with financial liability. Then we look at it. So units. Statement of comprehensive income. Friends, please a minute. Please a minute. I'm making a copy. I'm not going to go a minute. Hello, friends. Let's continue. Thank you. So, statement of comprehensive income extra for the year ended 30th September 2016. So this one, nothing will be in a profit or loss. If there was a dividend income, we would have brought it in a profit or loss. So we go straight to our other comprehensive income. Then we write fair value what? Fair value gain of 80 million minus what? 12 million. Did you get it? Fine, do you get it? So we come to, you can hear me. Oh, they can't hear me.
Mm-hmm.
You can hear me.
We can hear you.
We can hear you.
We can.
Statement of financial position. Extract. Blah, blah, blah. Let us all protocols what observed. So we have non-current what assets. You can just write investments or equity investments. That's how much? 13. And
Okay.
because of the OCI, we need to take the OCI figure to equity under either capital surplus or other component of equity. So you can take it to capital surplus. 1.0. Did you get it? Hello, did you get it? When this investment is finally sold, then the any balance in the capital surplus is now transferred to retained earnings. Did you get it? Okay.
Yes, sir.
Please, any question? There's no question. Are you? We thank God. Let's go and pick another question. I think we've done a lot on in terms of assets. 12 is interest-free loan, 13 is subsidized loan. We'll come there. 14. So let's look at question 14. Question 14. And I read. So still, we are not seeing any melodious voice. Oh, all along, was I showing only the question or the board?
Good.
I mean, when I was solving the question, was I showing the board?
Yes, sir.
Okay, then that's okay. So question 14. So please, if you have printed the questions, do our studies on 12 and 13. We'll come back and look at it. On 1st January 2018, Onetouch issued 10% loan notes at their nominal value. Now the line word is issued. Let me insert so that I can underline the important things. You will surely be fine. The match is I'm expecting financial instruments. So the topic was strategically hot to see. Updating. So this is 14. Now this one the 18. 10 minutes. 7, 8, 11, 12, 13, 14. Okay, so I hope it's readable. Okay, well. So are you seeing my board now? All right, question 14. So the word is issued. Is issued. I hope I'm showing the board.
You can see the question.
So
Okay,
you can see the question.
yes. So I'm showing the board now. So issued. I've underlined issued. So the word issued tells you that once we are in the books of Onetouch, then financial asset doesn't come in here. Did you get it? Issued 10% loan notes at their nominal value of 60,000. The loan notes are repayable at a premium of what? 19,880. Which means that assuming you are supposed to do amortization, then the redemption value will be how much? How much will be the redemption value?
79,980.
Yes, it will be 79,980. When they say it's redeemable at a premium of 19,980, it means that you need to add the face value to get the redemption what? The redemption value. After 3 years, that's giving an effective interest rate of 10%. So we are asked to show the relevant extract. So an examiner will fall in love with you if you start by telling us the type of financial liability. So what type of financial liability is this? This is a financial
So
liability. We solved one liability, I think question 2 or so. Okay, this is a financial liability amortized cost, right? At amortized cost, because the contractual cash flows include principal and what? Interest. And the fact that they said that it is redeemable after 3 years, it means that Onetouch is holding it up to the maturity what? Date. Did you get it? And the business model objective is to hold. Business model objective is to hold the assets up to maturity. Up to what? Maturity. So now let's look at the measurement. The initial measurement or the initial amount to recognize.
So please, the last sentence, you said
Because the
asset
contractual cash flows include principal and interest, and the business model objective is to hold the asset up to maturity.
Yes,
So I think we are not dealing with financial asset, right?
yes, please.
So we have to end here. We don't have to bring business model objective. Since it's not financial assets. If it's a financial asset, then we'll add that one because the intention is to hold it up to maturity. And for financial liability, you just look at the contractual cash flow test. Doesn't include principal and interest. If that's so, then it's amortized cost. Did you get it? Okay. So initial amount to recognize should be the face value. Face value is how much?
60,000.
60,000. Was there any discount? Was there any transaction cost?
No, sir.
If there was any discount, we would have deducted, right? If there was any transaction cost, we would have deducted. We learned that financial liability, we deduct transaction cost. Financial asset, we add transaction cost. Do you remember?
Yes, sir.
Yes, sir.
Okay, so remember that trick, because that trick can make you come back again. And by the
What are you
time you
coming to?
come back, we would have increased the fees.
What are you coming to do?
Abi, ICA will not consider you, so you come and meet me here. Okay, now let's look at the subsequent measurements. Subsequent measurement. Subsequently, it should be measured at what? Amortized cost. Subsequent measurement. Subsequent measurement. At amortized cost. So we need to do the amortization, is that not it? So we have the year starting from 2018. So 2018, 2019, 2020. So balance at start. Effective interest at 10%. Nominal interest. Oh, nominal interest. Oh, I think this one was a mistake. Those who are printed, you can correct it. It's a 0% coupon bond. Did you get it? Hello? Hello?
Yes, sir.
It's
Yes,
a
sir.
0% coupon bond. So the nominal interest is what? 0%.
3%.
Yeah. Then the balance at year end. Balance at year end. Balance at year end. Okay, so the start is 60,000 effective interest. So you can choose to ignore the nominal interest since it's zero coupon. Did you get it? But you can bring it once you are doing the formula work, you bring it. You know, the headings too, they carry marks, so you just bring it. So 10% of this is 6,000. This is zero. This will give 6,000. 66,000, right? So this will be 66,000. So 6,600. Zero. When you add, you get 72,
600.
600. So 72, 600. This will be 7, 2. 10% will be how much?
7260.
7260. So when you add, you get how much?
79860.
79860. Yeah. So, but this figure itself should be changed. This one should be changed to 19,8 what?
60.
860. So that is it. That's how the question should look like. So now your income statement will just be a copy work. Income statement. All protocols observed. We assume that the name, the CD, everything is there. So profit or loss, 2018, 2019, 2020. So profit or loss, we have the finance cost, right? We are in the books of the issuer. The issuer will incur finance cost. So that's how much? 6,000, 6,600, and then 7,260. Then statement of financial position, assets. So that is non-current liability. So we have loan notes, 66,000. At the end of 2019 to be current, right? Right.
Yeah.
So current liability. We have loan notes, 66,600. By the end of 2020, it would have been redeemed, so zero. So that's it. So this is how to solve such a question.
72,600.
Yes, it would have been paid. So you put zero there.
What about the current liability?
The current liability, it says how much?
72,600.
72,600.
72 about, where did I pick the 66,600? Okay. So this one, 72. The public officer is deceiving himself by this well. Okay, so this is it. I hope you are fine. The way you are not asking questions, it means two things. It means you understand, or you don't understand anything, and because of that, you think your problem cannot be solved here. I want to choose the first one.
So we understand.
That you understand, okay. But your friend, they are not joining you. You're only 25. Do you know that?
Yes, we were 30 before.
Is that what?
We were 30. We were 30. Now it has dropped to 25.
But 30 cry is still no good now. Once you do something and you say it's free, students don't like it. I don't. God have mercy on my people. Charge them a hand. Hey, drum with Diana. Most of them don't know. Madam, is that Saturday we didn't meet, so we don't have Saturday. I think I owe you the last meeting videos. I'll add to this one now. Okay, so let's move on. Let's go and check the other questions. We want to solve all the questions that has to do with the explanation we've already had. Did you get it? So let's go to question 15. Then let's go to question 15. Then we go to question 18. So 18 is on the the effect of credit risk that we talked about. So we can look at the 18. So 15 and 18. So take so that we know the ones that we've not done. So let's go and do 15 and 18. Then after that, we see if we can have time to look at the interest-free loan and the subsidized loan. So 15. So let me go and insert. Permission to insert. Let's
Roberto.
Okay, so a minute, I'm inserting. Okay, so let's look at it. Let me show the whiteboard. Okay, so on 1st January 2018, Onetouch issued 4% loan note. The underlying word is what? Issued. So the 4% here is the coupon rate or the nominal what? Rate. Is that not it? With nominal value of 40,000. So this is the nominal value. Then loan notes are issued at a discount of 2.5%. So the discount will always be computed on the face value. Discount should always be computed on what? On face value. On the face what? Value. Just like the coupon rate, it should also be computed on the face value. And 1,068 issue cost. Since we are talking of financial liability, unless it is at fair value through PLL, otherwise the issue cost should be added. The loan note will be repayable at a premium of 10% after 5 years. The premium of 10% means that the redemption value, it means that the redemption value should be equal to 44,000. Do you agree?
Yes, sir.
Do you all agree? It means that we should get 10% of the face value, which is 4,000. So when you add up, we'll get it. Okay, so let's see. The loan note will be repayable at a premium of 2% after 5 years. The effective interest rate is 7% per annum. All right, so let's see. What is the amount? What amount should be recorded as financial liability when the loan note are issued? That's the initial amount to what? To recognize. And then what amount should be shown in the income statement and financial position? So this one, answer. I would prefer you provide an explanation before. You understand that this is a financial liability at amortized cost because the contractual cash flows includes principal plus what? Plus interest. Now, Foster, please ask your question.
The question was in the chat box.
No, your voice is very far away from the phone. We can't hear anything.
Play now. Sorry.
We can't hear you.
Audible now.
We can't hear you, so you can write it in the chat section.
Yeah, it's in the chat box, please.
Yeah, we can hear you now.
Yeah, it's in the chat box. Please
Okay.
look at it for me.
Under what specific circumstance are financial assets and financial liabilities classified at amortized cost? If the cash flows includes principal and what and interest, and then when it comes to financial assets, you also have to check the business model objective. If the business model objective is to keep the asset up to maturity, then it's at amortized cost. Did you get it? If the business model objective is to keep and also to sell at any point in time before maturity, then it's at fair value through OCR. So watch the beginning videos. We've looked at this thing under the recognition criteria. Okay. So initial amount to recognize. So that will be the face value or the par value. The par value is how much? 40,000. Then there will be a discount of 2.5% times 40,000. That'll give us how much? 2.5% of 40,000, how much? Is how much? Is how much?
1,000.
1,000. So there was issue cost. That's a transaction cost. We will deduct. Is that not it? If it's at fair value 2 P&L, we would have expensed it. So how much are we getting? 37. 37 what?
$932.
So this is the A part of the question, the initial amount to what? To recognize. Now let's look at the income statement and financial position. Before we can do that, we need to do the amortization. Is that not it? That's the subsequent measurement. At amortized cost. So we have the year, we have the balance at start, we have the effective interest at 7%. We have the nominal interest at 4%. Then we have the balance at year end. So the year starts from 2018, 2019, then 2020. So the balance has start 37,932. So 7% of 37,932. We know that after everything, we should get something approximately 44,000, right?
Sir,
So 7%, how much?
26.
26. 55.
26.
55.24.
Now I want the nearest whole number.
2655.
2655.
2655.
Then 4% of 4% of the face value, which is 40,000. 4 for 16, right? So around
That will give us
1,600.
1,600.
So we did that. So how much are we getting?
$38,987.
So 38,987 plus 7% of that, how much?
$27,290.
27.
290.109.
Hey, baby, sir, please.
says 2729.
29.
Yes.
Okay. See now, sir, who you so office when you be on? I was so akasa. Well, who go choose answer? Oh, we work as all this no. Oh, open 991 MS. I understand. Okay, so
Okay.
minus 1,600. How much are you getting?
40116.
4016. Oh,
111.
this is mama want to me one can save every home. Calculate be you. This one and typewriter, they will just be making noise like that.
In fact,
Okay. Please, the interest, the effective interest.
2808.
08.
Minus 1,006.
41,324.
What? It's for how many years? 5
It's
years.
5 years.
I mean, I'm there. So I didn't February. It's 3. 41.
324.
So 2021. 41,324.
2893.
2893. Let's 1,006.
42,617.
617.
42,617. So 42,617.
2983.
2983.
44,000.
So that's the redemption value.
44,000.
I hope you are
Yeah.
getting it. So
Yes.
you just prepare your extract, your income statement extract. Twenty 2018, 2019, 2020, 2021, and then 2022. To profit or loss. So profit or loss, so we have finance or finance cost, right? Please not be so.
Yes.
So 2893, 2983. Then in the statement of financial position, we have non-current liability and then current liability. So on a non-current liability, we have loan notes. (2018) will be 38,987. 2019 will be 4116. 2020 will be 41,324. 2021 will be so on a current liability. We have the loan notes. Dash, dash, dash. Then this will be 42,617. And this will be 0. Did you get it? Hello? Hello? Do you understand?
Hi.
Along the
Yes, sir.
line, if time is our limiting factor, once we do amortization like this, we will not even post the financial statement extracts because we know how to post. Is that not it? You just copy and paste. Is that not it?
Yes.
Okay.
It is.
Now let's move. So today we've done how many questions?
3.
Okay, only 3. We've done question 11,
14, 15.
14, 15. Okay, so let's go and look at the effect of credit risk. Who can tell us what we learned about that? Where we have financial liability at fair value through profit or loss, we looked at the effect of credit risk. We said that any change in fair value caused by the credit risk of the entity should be shown under OCI. That's what we said. If there's a change in fair value of the financial liability at fair value, and it is caused by the credit worthiness of the entity, then it should be taken to OCI. And then the equity side, other component of equity. Is that clear? Please, is that clear?
Sir, why?
Yes, sir.
Is that what?
Why should take it to OCI?
Yes, because it is not a realized gain. It's not something that is reflecting your pocket. It's not a realized gain.
Okay.
You are saying that your fair value has increased. I getting it. Yeah, the fair value has increased because of your credit risk. And don't forget that we can wake up tomorrow and your credit risk will be better. I getting it. It will be improved.
Yes.
Can you imagine a company that is not doing well? If the next day you wake up and Elon Musk has now become a major partner of that company, I mean, that day, no, the credit risk will improve. Is that not it?
Yeah.
Is that not it?
Yes, please.
Send Robert to go and take loan from Fidelity. They will not even give him the loan. If they will give Robert the loan to I'm a teacher, he will say 25, 30. But let Robert go with Dangote's name. Oh, because Dangote confirmed that he's guaranteeing for that loan. Hey, in fact, I can even get that loan at 10% because the risk is very low. Low. I hope you get it. So credit
Yes.
risk can change at any point in time. So
Okay.
we show everything under what? Under other component of equity. Okay. Now let's move. So I think we need to look at question 18. Is that not it? Let's go back. Question 18 has that one. Question 18. So meaning this is our fourth question, right? So we would have done 14 questions in all. I can't think. Okay. Tomorrow to try and then come and do about 4. That would mean I would have done 18. Thursday, yeah, 4. Can I say, yeah, just say, yeah, yes, sir. Yeah. Question 18. Alpha Limited regularly invest in assets that are measured at fair value through P&L. On January 1st, 2018, Alpha Limited issued 9% debentures at nominal value of 80,000. So you see the first statement. It is there to confuse you. They regularly invest in assets to fund that liability. So the intention made a statement that they regularly invest in assets that are measured at fair value through P&L. But you know that they are talking about financial liability. They came down to say that on 1st January 2018, Alpha issued 9%. So the instrument we are dealing with is the instrument they issued, the 9%. Did you get it?
Yes,
Did
sir.
you get it? If you go and treat it as financial asset, you come back. Come back. Okay. And by the time you come back, we would have increased the fees. In fact, IC themselves too would have increased the subscription and exam fees.
I say, why is it that now every sitting they increase?
Oh, last sitting too, did they increase it again?
They increase the subscription.
But the exam fee they didn't increase, right?
Slight increment.
Maybe because we forgot to talk about that one because for the exam we all want there to complain that the thing our normal thing has been yearly. I getting it yearly. Because even those of us who have class, we only increase it yearly. Hours for the past 2 years, we've not even increased. Like with the same that we have moved to 2026 yearly. The economy is hard, no so. Well, workers were given only single digit increment or 10%. You were giving 10%, or we were giving 10%.
You.
So that increment, they will come back and take it by increasing the electricity and those utilities.
Okay, question 18. Question 18. Let me show the board. Am I showing the board? I believe it's the board that I'm showing, right?
Yes.
Okay, so let's see. So Alpha issued 9% debentures at a nominal value of 80,000 to finance similar investment in assets. The management had decided to classify these debentures to be measured at fair value through profit or loss. Alpha Limited credit rating also dropped in subsequent years due to some factors. These debentures were revalued to fair values as follows. So from 80,000 at the end of 2018, it moved to 88,000, which means that there was a fair value gain, right? Is it a gain loss?
Yes.
There was a fair value loss of 8,000, right? This is a financial liability. So if it increases, it's a loss, right?
Yes.
Hello? You have a liability of 80,000 at inception. At the end of the year, it has increased to 88,000. I believe you have a loss.
Yes.
They are saying that out of that 8,000, 3,000 was caused by the credit worthiness of the entity. So the fair value loss of 8,000, 5,000 will be taken to P&L, and 3,000 will be taken to OCI. Did you get it?
Okay.
That's all what anything. Now, the next year, 82,000, meaning there's now a gain of 6,000. But I say that gain of 6,000, there was an improvement in the credit worthiness of 5,000. So 1,000 will go to P&L and 5,000 will go to what? 5,000 will go to what? OCI, right? Hmm?
Yes.
Yes, sir.
Okay. Let me change the
Yes.
scenario. Assuming the improvement in the credit risk was about 7,500. How much would have gone to P&L? P&L would have taken a loss rather. Did you get it? P&L would have taken a loss of 1,000. Did you get it? Did you get it?
No. Mm-mm.
Please, sir, why 1,000?
I'm saying that right now, you agree that there's a fair value gain of 6,000, right? As it is here,
Okay.
this one. You agree
Yes.
that there's a
Yes.
fair value gain of 6,000.
Yes.
That 6,000, P&L will take how much?
5,000.
Then OCI will take how much?
5,000.
5,000.
Okay. So in other words, how do you get the P&L one? It's 6,000 minus what?
5,000.
5,000. Right? So negative 6,000 minus 5,000. Is that not it?
Okay.
So again, that gives you 1,000. So
1,000.
if this 5,000 was 7,500, it would have been negative 6,000 minus 7,000 what? 500, which will be poor. So the answer will be what? 1,500, which will be a
1,500.
loss. Did you get it? This one is negative.
Okay.
The negative here means that it's a gain. So this one will be a loss. Okay, added by the way. Okay, so this one, what they are testing you is just the fair value, how you know that the part that is caused by the credit risk should be taken to OCI, and the part not caused by credit or the remaining part not caused by the credit risk is taken to profit or loss. So show extract of the statement of comprehensive income. So this how you start. You say that this is sometimes you say explain and show. Me, I like the explain and show. So always I want to treat it as explain and show. If the question does not say explain, you go straight to the point. Did you get it?
Okay.
But all the questions
Yes, sir.
we saw that I've treated them as explain and show. When you explain, the examiner falls in love with you. So this is a financial liability at fair value through P&L. It must be measured at fair value. It must be measured at what?
Fair value.
At fair value. At the end of each reporting period. Any change in fair value caused by the credit risk of the entity. Any change in fair value caused by the credit risk of the entity. How will you treat it?
It's taken to OCI.
Is taken to OCI or is shown under OCI?
OCI.
Is shown under OCI. This is the most important point that I want us to write. All right, so let's move. So straight away, the name is Alpha Limited. So Alpha Limited. Statement of comprehensive income. So I want us to deal with the interest-free loan and the subsidized loan as well, so that would have done about 16 questions for the year. These I beg you, because we missed last Saturday, let's sacrifice more.
Okay.
For the year ended 31st December. (2018) and 2019. So profit or loss. Profit or loss. Are we? So profit or loss, what do we do? The first one we said is a fair value or loss, right?
Loss.
Fair value loss. So we come to other comprehensive income. So we say fair value loss. So fair value loss for other comprehensive income will be 3,000. Is that not it?
Yes.
So
Yes.
P&L will be 88,000 minus what? 80,000.
80,000.
That's 8,000. Then we deduct the 3,000 from it, right?
Yes. Yes.
So that will give us 5,000. Is it 5,000? Yeah. 5,000. Exactly.
Yes.
This is a fair value loss. It's an expense, so you may want to put it in bracket like this. So the finance cost that we treated in our previous question is expense, so we put this in bracket too. Now, the next one, 2019, is a fair value gain. So you write fair value gain. How much?
6,000.
6,000. So that's a gain. So when you come here, the fair value gain is going to be 88,000 minus what? 82,000. Then we deduct the one that has been taken to OCI. How much? It's not 5,000 right now.
It's 5,000 rather.
5,000, yes. So minus what? 5,000. So that will give
5,000.
us 1,000 as a gain,
1,000.
right?
Yes.
So 1,000 as a gain. So that is it for the comprehensive income. So the financial position, we we have 2018 and 2019 financial liability, right?
Yes.
So we have non-current liability.
Liability.
So you write loan notes. It's a debenture, right? So you can write debenture since the name was given.
Okay.
How much?
It's
80.
It's 88.
And this one will be 82,000.
82.
So that's all. Did you get it?
Yes,
Yes,
sir.
sir.
Okay. So this one, the emphasis is on the fair value issues. The interest is not, we are not that interested in that, but in practice, the interest, since you are paying interest, it will be part of finance cost. You show it in the P&L as finance cost. Did you get it? The nominal interest. Okay. So now, let's go and take some pictures. Then we take the next 30 minutes or so to look at how to treat interest-free loan and subsidized loan. Once you know one, you know the other. It's not difficult. We are looking at it in the books of the lender and then in the books of the borrower. It's just the same thing. If the lender is recognizing a finance cost, let's say an interest income, then the borrower will be recognizing finance cost, right? The same amount, but finance cost, so it's not difficult. Yeah. So let's take question 11. Let's take pictures. Can I move to the next page? Can I move?
Yes.
Okay. Page 2. Have you really been sending a PDF on the page? Or you are tired of sending?
Yeah, the last class, I think the person has not shared it yet.
And where were you?
So I couldn't
We
join.
don't know the
I
person.
was locked up somewhere, so the last class I couldn't join.
We don't know the person. So everyone here is the person. Okay, let's move. So this is the next page. Can I move?
Yes.
Okay. These are moving now.
Okay.
Okay, so this is the last page. Okay, so let's look at how to deal with interest-free loan. The same scenario or approach we use for the subsidized loan. So let's look at interest-free and subsidized loan. Okay. Nyame te ase. Are you ready? Are you ready? So let's end this recording, then we start that as a different recording, okay? Because it's a different subtopic.
Okay, sir.
Okay.